rental is not increasing every year. It's really hard as a property investor to catch up with your monthly expenses, especially if it's cash flow negative.
Here's where the problem is. A lot of people are too worried about how do I run away from taxes, and you're not thinking about how do I grow my portfolio. First, let's grow our portfolio. Once our portfolio is actually grown, that's when we can start worrying about taxes.
And
we are live.
So what happened during the weekend is that we hosted a property workshop for 10 of our clients. And what we were doing is that we were searching for property deal. It goes back to sometimes when you do not have the content, you will not understand what we mean when we're saying that not every property is an investment. And we also called estate agents to come through and pitch property deals. That was beautiful, man. I don't want to lie, because this week alone, out of that meeting, we've got 3 viewings, and then we're still yet to follow up with them and ask them how did the viewings go, and how was your weekend?
No, my week, hi Dan. So my week was really interesting, right?
Yeah.
Interesting to a point whereby we're in a situation right now whereby we purchased the property, and with this property that we purchased, we're still on no man's land. No man's land meaning that the property is not registered in our name. However, it is actually going to be registered into our name. But now the bank hasn't really accepted. So it has accepted from our side, but now we're just waiting from acceptance from the bank side or the value of the property. Now, I shouldn't be scared for this, but now it's always just crossing fingers, hoping that the bank will actually apply or say that the bond has been approved. So now let's speak property, right?
So when we're saying cash flow negative and cash flow positive, we're speaking about the results, looking at it from returns. So if I'm saying that I've got a property that's giving me cash flow positive, I'm saying that after all my expenses, I'm left with money. Whereas if I'm saying that my property is cash flow negative, it means that I, as the owner, still need to take out money from my pocket in order to make sure that my operational costs are met. So that's the difference between cash flow positive and cash flow negative.
Exactly. So if your property requires you to take out money from your pocket, that's a cash flow negative property. Now, here's where a lot of people have a problem because of the author of the book Rich Dad Poor Dad, when he said that as long as a property is taking money out of your pocket, it's a liability and it's not an asset. Now, I know a lot of accountants will say that, no, but property is an asset because you can release some sort of equity from the property or something like that. But now, when you're looking at property investing as a sole business, right? Say, for instance, right now, you have a business, you don't have any income from your workspace, you don't have any income from your core business, and you're just looking at this business that we're talking about, which is property investing, right? And now looking at this particular business, you're asking yourself that, will this business survive if it's running cash flow negative? So we said cash flow negative means that money needs to go out from our pocket, so I'm making a loss. If I'm saying that property right now is my core business, I cannot afford for the property to be cash flow negative or to be losing money.
Right, let's put numbers to what Lebo mentioned so that we can simplify what he mentioned, because I know it can just easily go ahead of us. So let's take it back now to property investing, looking at today's topic of cash flow negative. So what we're saying is that looking at our transfer cost and our deposit, let's just say that we also put in 100K into that property. Now the challenge now is that looking at it from cash flow positive and cash flow negative, the person who's running at a cash flow positive will be similar to that example that we put earlier on, whereby after all expenses, they are making 5,000. So in order for us to understand when will they break even, what we'll simply do is that the 5,000 times 12, so the 5,000 is our cash flow positive after all our expenses, after the bond, after the electricity, after the rates and taxes. We multiply that by 12, of which we're getting 60,000. So when I'm looking at 60,000, 60,000 is my annual net. It's my annual net. And then now what I'll then do, multiply that by 2, and then I already know within 2 years, I would have received that money back. Now let's go back to the cash flow negative. Looking at the cash flow negative when it comes to property investing is that now we are losing, let's just say that on a monthly basis, in order for me to meet my operational costs. When I'm saying operational costs, I mean, if I'm adding my bond, my levies, my rates and taxes, my insurance, all of those expenses, I know that, let's just say that I need to pay 10,000. But now when I'm looking at my rental income, I am just getting 8,000. And here's the challenge now. Looking at my neighbors, they're also charging 8,000. Now I'm in a situation whereby if I'm to say that, but I'm making a loss of 2,000, because if I'm going to say 10,000 minus the 8,000, I'm then left with the 2,000. So now this 2,000 will then be your cash flow negative. Now the question is, how do I go around that, looking at that situation? A bond, we're looking at it, it's 20 years. A bond is 20 years. So what we're then saying is that you will be taking out, best case scenario, you'll be taking out this 2,000 for the next 20 years, of which we know that it's not true because your rates and taxes and your levies go up on a yearly basis. And I mean, if you have been living in South Africa, you've seen the interest rates, how they're going up. So already we know that your expenses will not be fixed. But now on the contrary, if we're looking at our income, rental is not increasing every year. It's really hard as a property investor to catch up with your monthly expenses, especially if it's cash flow negative. Our total investment was 100,000 and we are losing 2,000 every month. So in order for me, we did say that this is best case scenario of nothing increasing, of which we know it's not true. But for the purpose of this example, just so that we can draw this picture that we're trying to put across. So 2,000, which is our cash flow negative that we're taking out from our pocket every month, times this by 12. What's happening here is that I would have taken out from my pocket 24,000 within that year. So if I'm going to say now, look at it in business terms, I'm sitting with my accountant, I'm sitting with my two coaches, property coaches, and now it's not that I'm owning this property. They're like, let's look at the numbers. What I will then do is that I'll add my 100,000, which was my deposit and my transfer cost, with this 24,000. And then now, looking at it after year one, I already understand that my total investment was 124,000. So looking at it, if we're saying that rental is not increasing every year, what's going to happen then is that let's just assume that they'll stay the same. So we're not looking at best case, we're not looking at worst case. So if we're going to say now 24,000, which is the money that I took out on a yearly basis, times 20, that will leave me at 480,000 that I would have taken out from my pocket when it comes to cash flow negative. And then now the 480,000, we're not done yet. The 480,000, I'll add it with my deposit and transfer cost, which is 100,000. So that puts me at 580,000 that I would have taken out from my pocket. Now looking at property as a business now, this is where a lot of people miss it, because now they'll only focus on appreciation in a sense of this property. When I bought it at 1.2 million. But now when it comes to selling, I sold it at 1.5. So I made a profit of about 300,000. And then now you're like, but did you consider the expenses? Did you consider the money that you were taking out from your pocket? Did you consider the money that you put in as deposit? People don't consider that. Hence, we are like, let's go back to the numbers and really understand the formula when it comes to property investing.
Now, there's something that I want to also touch on that really breaks my heart as a property investor, especially when I see this, right? Now, there's a tax law whereby they're saying that if you're buying X amount of developments, then this basically means that you, as the property investor, won't be paying any taxes, or you would get a tax refund, right? Now, let's really think about it. If I'm going to be investing in property, am I investing in property to run away from taxes, or am I investing in property in order for me to get a cash flow? Now, I know a lot of people are going to have a heartache with this one, but when you're looking at taxes, right, the taxes, you only start paying taxes, especially under business, once you have passed a certain threshold. Now, threshold, there's something that's called threshold in taxes. Threshold says that you need to be earning a certain amount of money, right, in order for you to start paying taxes. Now, the last time I checked, it was sitting at around 93,000. Don't kill me. I'm a property investor. I'm not a tax guy. I'm not an accountant, right? Now, it was sitting at 93,000 the last time I checked. Now, let's take this into consideration and really think about it, right? If, say, for instance, right now, I'm having a property. I won't go deep into the numbers. I'm having a property and it's cash flowing 2,000 on a monthly basis. Now, if I say 2,000 multiplied by 12, that amounts to what? 24,000. Now, if it amounts to 24,000, what does this mean for you as a property investor running the property under your business? This basically means that you won't be paying any taxes. Now, here's where the problem is. A lot of people are too worried about how do I run away from taxes, and you're not thinking about how do I grow my portfolio. First, let's grow our portfolio. Once our portfolio is actually grown, that's when we can start worrying about taxes. I mean, if we can say 93,000, can you please borrow me a calculator? If we can say 93,000 divided by 12 to understand that how much should I be making in profit in order for me to start paying taxes, I need to getting paid 7,750 on a monthly basis to actually start paying taxes as a business. Now, that's something that I really need to consider, that if I'm only making 2,000, then why am I running away from taxes and saying that I want to buy these cash flow negative properties in order for me to not pay any taxes? Now, that's something that I really need you to consider, number one. And now, number two, if I'm saying that I'm buying a property in order for it to be cash flow negative and then I'm running away from taxes, this means that you're basically saying that I'm taking on more expenses in order for me to get a property. Now, it doesn't really make sense if you're putting it like that. Now, I really want you to understand that the content behind property investing, how do I get a power team, right? We call it a power team or mastermind or whatever that you want to call it. How do you get a team that is able to actually advise you? So now that we've spoken extensively, I mean, a whole lot of people understand right now what cash flow negative properties are. Now, I really want to emphasize this. If you're going through a property investing or a property that's cash flow negative right now, or you're going to be purchasing a property that's cash flow negative, I really need you to understand what you're putting yourself into. Because this basically means that if, say, for instance, you were saying that you're losing out 2,000 on a monthly basis, and it was okay because you had a job that could afford you the loss of 2,000. Now, once you get laid off from work, right, the 2,000 now becomes a lot. Reason being that if I'm having, let's say, 12,000 on a monthly basis, and from this 12,000, I'm saying that I can sacrifice the 2,000 and live off the 10,000. Once the 12,000 is gone, now it becomes really expensive for me to keep the property. And now what happens most of the time, trust me, because I know this, I'm a property investor, I've seen it happen countless times in the market. What then happens is that once you get laid off from your job, the first thing that you're going to be selling is that cash flow negative property. The property that needs you to take out 2,000 on a monthly basis. Now, if it's the inverse, whereby the property is giving you the 2,000 on a monthly basis, even though you do get laid off, you do know that you're getting some sort of income from your property. Now, that's something that I want you to really take into consideration. Now,
okay, once you're on that, right, I want to use two scenarios to show you the outcomes that we've been having Zoom with the guys and the ladies, and this is what we've been seeing. So there's this type of property investor, we'll say type A, and then you'll just tell us which type are you there by the comment section. And then we also have type B. Type A would be someone who's running at a cash flow negative. So they need to take out money on from their budget to make sure that the expenses are met. Now this 2,000, which is cash flow negative, now let's say they buy another one, which is another cash flow negative. They buy another one, which is another cash flow negative. They buy another one, which is another cash flow negative. Finally, they buy the fifth one, which is cash flow negative again. So if we're saying 2,000 times 5, that's 10,000.
Yeah.
And then on the other side, the inverse is the opposite. That's us. We are saying that at no point will I buy a property that's cash flow negative, because I'm using this cash flow as leverage for me to buy the next one, in a sense whereby if there's a plus on my side, I'm growing my business profile. So if I have a property that's giving me 2,000, so this is cash flow positive, 2,000 times 5. Now this is 10,000 coming to my pocket. If you are looking at retirement, when it comes to planning your retirement, when it comes to property investing, we should be looking at which type of person do you want to be. Because last thing you want is you buying all of these properties that are cash flow negative. Now when you retire, it's more of let me use the money that I got from where I was working to finish this bond so that I can get my money. I can see what I'm working for. Whereas type B, he or she was like, I'm still getting 10,000 and this is really good. How do I continue growing? So at the end of the day, we always emphasize that property investing is a numbers game.
Yeah. So Zen asked, right?